Chart Watchers, and welcome to this June 25th Market Watchers live show with your host, Tom Bowley and Arthur Hill. Erin Swenlin is off today, and she'll be back with us tomorrow. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, it's an interesting morning so far. The Dow Jones Industrial Average down 362 points on renewed trade fears. The S&P 500 down 42, heading down toward 2,700, where we've seen some pretty decent support over the past couple of months. The NASDAQ down 169 points, losing its 20-day moving average. The Russell 2000 down 31, doing the same. 10-year Treasury yield down 2.5 basis points to 2.875%. Volatility has shot up 29% as fears grow over the trade tensions. Utilities continuing to push higher. This is the one group that is leading to the upside today. We did break out above the late May highs, but you can see the late April high holding so far as resistance. Technology, the roughest of the sectors so far today, you can see down about 2.25%. Energy also taking it on the chin, along with consumer discretionary, although I did notice the retail stocks holding up better than some of the other areas of consumer discretionary. The DJUSRQ, this is the weakest area. Recreational services down a ton, and part of the problem there, Carnival reported earnings this morning. They did beat top and bottom line, but the guidance was not good. They lowered guidance for the next quarter and for the fiscal year, and as a result, the recreational services area, many of the cruise lines down today. Here is Carnival Corp. You can see down about 8.25%. So we are down quite a bit here, breaking down below earlier lows. Okay, it's a start of a new week. Arthur, I tell you, we had a tough start today. I mean, you think this is something we'll bounce back from, or what do you think about the weakness so far? Arthur, are you there? I was just saying, I mean, we got off to a really rough start this week. Obviously, Dow Jones down close to 400 points now. We've seen a lot of the global weakness, China getting hit. Now it seems like it's kind of moving over into the U.S. Is this an opportunity, do you think, or is it just time to sit on the sidelines?
Well, I would say it's time to sit on the sidelines to keep some of the powder dry, because you've got the combination of we're ripe for a correction. We've got the summer doldrums creeping in. And then last week, Erin noted that a lot of these sentiment indicators had hit extremes. So, I don't really think you can time the market with sentiment indicators or seasonality, but when they jive with some of the price action that you're seeing now, it could lead to a corrective period in the market. And for the S&P 500, that means kind of like what we've been doing all year.
Yeah, I follow seasonality pretty closely, as I'm sure you know, and a lot of folks listen to the show. I talk a lot about it. It's not just time of the year, but also time of the month. The 18th to the 26th tends to be, actually, I think it's technically the 19th through the 25th. So it's the close at the 18th through the close at the 25th, has historically, with December being the only exception, that has historically been the worst time of calendar months going back to 1950. I think I've got the S&P 500, if you include all calendar months from the 19th to the 25th of those months, they've produced annualized returns of minus 4.93%. If we take out December, that actually goes to a minus 6% annualized return for that time of the month for every month except December, dating back to 1950. So we're right there now. Mondays are the worst day of the week. Mondays that happen to fall between the 19th and the 25th are unusually bearish. And that's really what we have today. So I agree with you. I think we got kind of a perfect storm. We've got the technicals telling us to be careful with a lot of selling recently. And now we've got some of the seasonality lining up. It tells me things maybe will start to get better again, maybe as we head later into the week. But maybe in the short term, we're going to struggle.
Yeah, if you take that as normally you'd say you hit the sweet spot, and now we've hit the sour spot in the market. And as you said, it won't, the seasonality for the part of the month won't turn bullish until we get to that turn of the month, the end of the month, beginning of the next month. So that might attract buyers for a bounce there. But yeah, we could continue to remain soft.
All right, sounds good. We're going to get back into a bunch more of this technical jargon here in just a few minutes, but let's go over the upcoming schedule. Tomorrow I'll be doing a workshop. Then we have Scott Carney coming in on Wednesday. Dan Russo joins us on Thursday. And then everything stock charts back on Friday. So we'll get hopefully some tips and tricks on how you can better use the website. Today, what we're going to go over, we do have Monday setups coming up. Of course, we always do that on Monday. And then we'll follow that up with an earnings spotlight, talk about some individual stocks that have recently reported earnings, take a look at some of their charts. We'll get into the 10 in 10 Keen Group, ticker symbol FRAC will be our first stock. And then Arthur's going to do a little special segment for you, risk on and off analysis. So make sure you stick around for that. Okay, well, let's get into all of this because we do have a bunch of things to cover today. We did have one economic report out today, and that was the May new home sales. May new home sales came in much better than expected, 689,000 units versus 665,000 units. But the bond market, everybody doesn't really care. When you get kind of swept up in the selling that we've seen today, I think sometimes the economic news is just overlooked, at least in the short term. Also, you got to keep in mind, we're talking about May new home sales, and the market's already looking ahead. So some of it's just, lagging information that we're getting on the new home sales. But you can see the 10-year Treasury yield actually threatening its lowest level in June currently. We did put that late May low in at about 2.75%, and early April hit the low around 2.72. So those continue to be a couple of key areas that I'd watch to the downside on the yield. Of course, as the yield drops, that means money is rotating into treasuries. I'm sure Arthur may touch on some of that later in the show when he's looking at the risk on and off. But just keep in mind that as treasury yields move lower, that does signal a little bit of risk off and folks moving into more defensive areas of the market like treasuries. All right, I mentioned earlier that we are in a bearish period of the month, and June is certainly no exception. The S&P 500, you can see since the 18th, we closed on the 18th at 2775. June 19th through June 18th through June 26th. So it almost follows that weakness that we've seen throughout all calendar months, the 19th to the 25th. In June, it's actually the 18th to the 26th. That period since 1950 has produced annualized returns of minus 26.67% on the S&P 500. And you can see that we are currently following that historical pattern. This is something that goes back again, almost 7 decades. So this is a lot of historical data. And I think the more data that you have, obviously, the more representative it is and maybe a little bit more reliable. The NASDAQ, which also is struggling now, all of a sudden, we did see a lot of outperformance by the NASDAQ and the Russell 2000 recently, but not today. The NASDAQ down 2.5%, almost 200 points, breaking below the 20-day moving average. We did see the PPO starting to roll over, slight negative divergence, and we did have the reversing candle at the top and the failure to hold that breakout level. Looks like we're heading for a 50-day test to me on the NASDAQ. The NASDAQ over the same June 18th to June 26th period has had an annualized return of minus 22.9%, going back about the last 47 years or so, since 1971. The Russell 2000 for this period has had an annualized return of minus 44.37%. So this is across the board historical weakness. So yes, things look bad technically, but some of it, in my opinion, may just be following the historical patterns to the downside. A couple of areas, well, one area in particular that I was watching earlier with the new home sales coming out, home construction. Home construction, you can see breaking down beneath the May lows. We had a double bottom in mid-May at about the 765, 770 area. We are currently at 754. And now I think that longer-term support level on the weekly chart seems to be coming into play. That would be the breakout here above about 725. One of the things I've talked about with the home construction is be careful with this group until we see this weekly price action move back up above the 20-week moving average. We continue to drift beneath it, and now it looks like the price momentum is accelerating to the downside. This is a group that, at least for now, you certainly want to avoid. A couple of individual stocks. Google. I wanted to bring this one up because of the reversing candle. Look at that shooting star candle off of an uptrend. False breakout above that January high. You can see intraday, we went above 1200, which took out the intraday high back in January. And then we came back down and and failed on that breakout attempt. And from a short-term trading perspective, I think these candles are really important. You can see if you saw the reversal, decided to take profits as you hit resistance on Google. I can't call them Alphabet. I don't know what it is.
Me too.
It's Google. I'm sorry.
Always Google.
Yep, but we have reversed 3 days now. We've been trending lower now for the last 3 days. A huge down day on Google, 3.6%, $42. Looks to me like maybe this gap support area, which was a prior high, and also the rising 50-day, 1100 to maybe 1115 or so, seems like where Google may start to find some buyers. I'd be looking in that range.
You could also call that gap a breakaway gap, Tom.
Yes. Yep. We're kind of trending lower, and then it came on good volume too, which I think supports that argument.
No, the one today, right?
Oh, to the downside. Yeah. Off of this uptrend. Yeah.
Yeah.
Yep. And you're getting that volume too on the downside. So I agree. I think to the downside, unless we get a reversal, that would be bullish. I think if we were to close back up above the 20-day with some heavy volume and put in a long tail to the downside. But barring that, it seems to me like we should expect some additional downside. Would you agree, Arthur?
Yeah, I would think there would be some follow through on this breakaway gap down. So yeah, it needs time to find its footing. And I like that 1100 area as well.
Yep. Let's take a look. I'm going to go ahead and go into my blog article from this morning just to save me from having to annotate a chart. But Qualcomm, I had mentioned under the sector industry watch, or actually I mentioned the telecommunications equipment index, which is home to Qualcomm. And off of a nice uptrend, it looked to me like we were in potentially an ascending triangle. I actually drew a dotted line here. I would prefer actually a little bit more weakness coming down here to test some pretty good support, gap support, price support, and then perhaps have a bounce off of that area. But if that were to develop like that, one of the key stocks I like in this space was Qualcomm. And under the historical tendencies, and I'll pull this up on a seasonal chart in just a second, but I did show that January through June, if you add up the average monthly returns, January through June over the last 20 years, that average monthly return totals 4.5%. But July through December, it's 22.7%. So Qualcomm has a much, much better track record in the second half of the year. So let's take a look at the Qualcomm chart. And let's just pull it up here. And let me bring up the seasonal chart for you first before we take a look at the sharp chart. Here is the seasonal chart. Now, all I did, you can see March tends to be a very strong month for Qualcomm, but if you look across, none of the other months in the first 6 months of the year are particularly strong. In fact, you got January, April, and June all declining by an average of more than 1% per month over the last 2 decades. But then once you get past June, and this is kind of unusual because not too many stocks have strong track records in July and August and even September. That's kind of the time when the S&P 500 struggles the most historically. But you can see Qualcomm actually has positive average returns July, August, and September over the last 20 years. And then, of course, you followed up with very strong action in October, November, and December when the market does tend to do much better. And so I look at these 6, you add these across, and that was the 22% that I'd come up with that I reported earlier. And these are average monthly returns. These are not annualized returns. These are average monthly returns by calendar month. So Qualcomm tends to do really well in the second half of the year. I also pointed out that they have a dividend yield right now of about 4.4%. So if we pull up Qualcomm on a chart, and I'm going to go ahead and pull up a longer term chart. Let's go back 10 years. We'll look at the weekly. And I'm going to throw in another indicator in here, which I think is great, especially if you tend to be more of an income-oriented investor or trader. Throw in the dividend indicator. And I'm going to update this chart over the last 10 years, weekly chart. And you can see that Qualcomm, over the last 10 years throughout this bull market, we keep seeing the dividends going up each year. And we are up over 60 cents now, which would be roughly about 240. Actually, I think it's like 244 a year on dividends, $2.44. And the stock's trading at 56.70. So there's your 4 point whatever % yield, dividend yield. I want to say it's about 4.4, 4.5%. But we've been sideways consolidating with Qualcomm for a while now, after topping back in the middle part of 2014. So maybe we make another push back up here to the 67 area in the second half of the year. That would be about a 15% return on the stock. Plus, of course, you got the dividends as well. So Qualcomm, I think, is an interesting play based on seasonality. It is breaking below the 20-day. I did like it on this 20-day test. But I think if we just look at a shorter term weekly chart, we're sitting right at about the two key moving averages. I think if we move much below 56, then I think maybe we're going to potentially bring in the bottom down here around 48, which we've tested multiple times over the last few years. So Qualcomm is a stock to kind of keep in mind, I believe, especially if we get a reversing type of a candle, knowing the historical pattern that we have on the stock. The New York Post reported over the weekend that Kraft, KHC, might be interested in purchasing Campbell Soup, CPB. So if we pull up CPB, you're going to find this is the best performing stock in the S&P 500 today. After gapping down, starting to show some strength recently, this is a pretty big move on Campbell Soup on heavy volume. 20 million shares already today. Looks like it's going to be the heaviest volume day of the year, looking to eclipse what was the high volume back on May 18th. But Campbell Soup breaking this downtrend, I think getting back up, completely filling that gap and moving beyond it. Looks like the character of this chart is beginning to change. And of course, it never hurts to have a company like Kraft saying that they might be interested in buying you. Let's see, Harley Davidson. They announced they will not raise prices to cover the cost of the EU's reciprocal tariffs. And the market doesn't like it. Market obviously feeling like that could impact their bottom line, not raising prices to cover for an additional cost. And so the market saying we're getting out. And the stock had been in a downtrend. I'm going to pull up a weekly chart because the daily only goes back 6 months here. But you can see the longer term daily chart. We're putting in these lower lows, lower highs, continue to drift down. We had a little bit of a positive divergence on the weekly PEO as we were moving lower. PPO started to turn higher again. That usually alerts me maybe to a little bit more than the 20-week test, and that perhaps we'll get a 50-week test, maybe even get that PPO back close to the center line. We didn't quite get there, but it does look like Harley-Davidson is rolling back over again. I wouldn't be surprised to at least test this 40 area, and possibly, if the market remains weak, I wouldn't be shocked to see Harley-Davidson back down to test that January 2016 low, down closer to $36. Not a good looking chart here. I'd have to see a little bit more technically before I'd be interested there. Red Hat was continuing its selling today. We saw the huge gap down on its earnings on Friday. Actually, the earnings came out Thursday after the bell, so the reaction was on Friday. Stock tried to rebound intraday and then closed back closer to its low on very heavy volume. I think Red Hat could be okay longer term, but it's going to take some time to settle down. 135 looks like the initial area of support for me. That's where we broke out above the January high. We never really went back to test that area. And then you've also got the 50-week moving average coming up just beneath 133. So I think we got a little bit more downside in Red Hat, but this is a group software that had been performing extremely well until we moved into the month of June. That group is taking a break. We're seeing money rotate elsewhere, but I think Red Hat is one that could rebound. Arthur, when you look at a stock like this, I mean, this is a stock, clearly it's been on a run for a long time. You know, if you come out with any bad news, you know the stock is due for a correction. After you get an earnings report or, you know, lowered guidance like Red Hat gave last week, is this a stock you would consider, or is this a stock that you would just let go because of the breakdown?
No, I would consider it, and that is for two reasons. First, software has been one of the strongest groups. If you just put it in, and you know, technology has been a strong sector. Software has been a very strong group. It's getting clobbered today, but I would definitely keep it on my radar because there's a consolidation coming into play. You can see in that November, December, January period. And because it looks like we're breaking below that March, April low. But, you know, we get into that 125, 130 area. I think that's an area that I could become interested. And if you go back to your weekly chart, you can see that, you know, it does tend to rebound. after these big shocks that it gets. If you look at that December 2016 decline on big volume, that was a scary decline, but it pretty much marked the low. So, this might be a washout, but I would wait for it to stabilize.
Yeah.
First.
Yeah, it looks like here from what, $81, $82, we went back down to about 60, 68, 69. So you're probably looking there at about, I don't know, 13, 14%. Not quite as much on a percentage basis as we just got last week. But this is stock, and I've seen you write about this. When you get a stock that goes up this fast, you got to give them a little bit more room and leeway on a pullback. I mean, you got to take the big picture in perspective as well.
Yeah, definitely. Definitely. And, it's this kind of volatility that creates opportunities. And when the market looks the riskiest and it's the hardest to pull the trigger, that's when, the opportunity is usually there. I'm not saying it's here right now. As we noted, we're coming into the summer doldrums and seasonality and sentiment aren't in our favor yet, but it's something to keep on your watch list when the market does stabilize.
Yeah, no doubt about it. I tell you what, let's go ahead and move into our Monday setups. This is a segment where we just provide some stocks that look interesting. This is going to be a difficult week to pull these up, obviously, when you see the Dow down almost 400 points and the S&P getting hit and the NASDAQ down a couple hundred. It does make it tougher because when the market sells off a lot faster than it goes up. When we get that fear spiking with these big moves to the downside, panic sets in. And I always say, market makers are going on vacation, and it's almost like the Matador where they're just putting out the little red cape and they just let prices go. It gets pretty scary. So it's hard to jump in, but that's our task coming up here in just a minute, Arthur.
And it reminds me of that classic, the market takes the stairs higher and the elevator down.
Exactly. Or just jumps out the window.
Yeah, we're still in the elevator now.
I don't know, 400 points. It's starting to look like a ledge. But anyway, these were the picks last week. Too bad Erin's not here, because I tell you what, she had a great pick this week. I give her credit. I had a good one until about Friday last week, and it turned around on me. But let me grab and take a look at CTL, which was her pick from 1805. 1805, and that stock, I know earlier was up today. Whoops. All right, that's the wrong ticker. Earlier today, it was higher. It is a utility, so it was a good pick because it's in a space that is performing well as the market moves lower. But you can see now the stock at 1869, it was 1805, so that's a 64 cent gain, which is about 3.6%. That's pretty good considering what the market's been doing.
Yeah, you annualize that. It's very good.
Yep. All right. Mine now is on a ski slope. Was doing really well until Thursday's close and even Friday's open. But many of the banks, again, have turned back lower. My whole theory with Zions Bancorp was, number one, it was a regional bank, which they've been doing much better than some of the big money center banks. And number two, I still believe that interest rates are going to go higher. They are down now to the lowest in June. Earlier, I was talking about 2.88, 2.89%. But I still think over time they go higher. So I do still like the banks. But we are now into a zone that I think is pretty important. I think last week when I talked about Zions, 53.5 to 54.5, in my opinion, were the key levels to watch to the downside. We did move higher, got up over 57. Now we're back down toward that lower end of the range. I still like the banks. I still like the regional banks. I like Zion, but I would be paying very close attention to 53.5. I would not want to lose that level on a closing basis. If so, I wouldn't necessarily give up on the stock. I just think there's a better chance we're going to head back down to maybe hit that 50, 51 level, and I wouldn't want to hold it through that weakness. Okay, so Arthur, we always say on here, we're never as good, or we're only as good as our last picks. We got to come up with some additional picks for next week. What do you have? You have some stocks you like with all the weakness going on today?
Well, I got a few that I'll go ahead and go out on a limb and take a look at here. And the first one, let me go ahead and grab the screen from you. Mm-hmm. But the first one is going to come from the biotech group, because large cap biotechs have been performing pretty well But the first one I'm going to look at here is going to be Gilead. Now, I admit that this is a bottom pick and it doesn't fit my usual style, which is usually on trend. I'm looking for something that is on a trend, and I'm looking to participate in that trend. And Gilead's been beaten down since this January peak around 88, all the way down to 64. And it's gotten a big bounce there in May, you can see. And I'm going to turn on my little cursor so you can follow where I'm going on this. It'll make it a lot easier. There we go. So you can see this big gap down. And that's kind of like a selling climax, if you will. And I can go to a chart. I've got some chart styles on the left there for quick access. And we'll look at the volume here. And you can see that there was a big volume, high volume decline there, and then started to firm and bounced all the way up and filled this gap. Well, you know, it's battling this gap zone, which is acting as resistance. You kind of have this support zone here, and it's turning into resistance. You got the falling 200-day EMA. But what I'm interested in here is this surge on good volume. There you can see the volume at the bottom, 2 good bars there. And we're consolidating. All right, we dipped below 70 and rallied back. And we got a pretty tight consolidation. And if we break above 72 here, I think that could mean further strength for Gilead. And I kind of consider this to be a, I don't know, it kind of moves to its own, the beat of its own drummer, if you will. It's not tied to the broader market like some of the stocks that are in the technology sector or the industrial sector, say. Biotech's kind of march to a different beat. The next one I have here would be,
Arthur?
Yes.
I have another thing to add too. Seasonally, June and July are very strong months for Gilead, and they are very strong months for the biotechs in general. July is the best month of the year for biotechs historically, and they're starting to show some strength. And I've said on here before, I've disclosed I own IBB, which has been trending higher above the 20-day moving average, actually testing it today. But I think that Gilead pick is interesting because it is in that group of biotechs that have been performing better. And like I said, Gilead performs best. Its 2 best months are July 1st and June 2nd.
I think I have a, sorry, I should have pulled that up for you, Tom.
Oh, that's fine.
Let me just pull that up right quick. But it is important that you get the industry group on your side. Were you doing IBB?
Well, that's what I'm doing. But yeah, Gilead, all of the biotechs tend to do extremely well over the summer. July, right there, you can see very strong for IBB. But if you pull up Gilead, you'll see that it's actually 2 of the June and July are the 2 best months of the year for the stock, which I find to be very attractive. If I like a group, and then I know that the stock within the group tends to perform really well. Yeah,
there you go.
Yep.
And up 5.3% on average.
Yep.
So it could be, maybe that's the month they come out with those phase 3 results or something.
There you go.
You know?
We can only hope, right?
Yeah, we can only hope. We do not have inside information, just full disclosure, you know. The next one also comes from the healthcare sector. It is Henry Schein. And it seems to be bottoming a little bit. And if you don't know where a stock comes from, there's that full quote checkbox there that you can click on and click update. And then at the top, you're going to see healthcare medical supplies for Henry Schein. But what we got here is we got a nice bounce and then what looks like a pullback. And that pullback looks like it could be a correction. Now, this is another bottoming stock, but the only reason I'm picking it is because, you know, the market's getting hit hard. So got to think a little bit different here other than chasing the normal momentum names. But when I look at a pullback, you know, I'm looking for a couple of things. First, I'm looking to see that it kind of firms around that 50% mark. And right now we're in that 50% area, firmed and turned up. So a pullback, it's 2 steps forward, 1 step backward, basically is the principle here. I don't think like 38.2 is an exact level, 61.8 is an exact level you must watch. No, it's really like a zone. And when it gets into that zone, that's where you want to see it firm and get the bounce. Another reason it looks like it's bouncing here is you can see that kind of resistance break there turning into support. And I'll color that red. And I could even draw some trend lines, but they don't match up very well. So I'm not going to draw trend lines here. But the last thing here is you had a resistance zone and you broke out, and holding that breakout today when the market's getting clobbered. So this one is looking pretty good in my book at this point. And I will save that to the market watchers list. Now the next one, and this one I would probably call my favorite, and it's not going to be my favorite food because the symbol is HRL. And I think we all know what Hormel is famous for. That would be spam. So what we got here with Hormel is it looks like it's consolidating after a pretty big advance. So you've got a resistance zone here in that 37, 37 and a half area. You had a nice breakout there. And we've been consolidating, and now we're 2 days up. We're even up today on a down day in the market. And I would consider this, a bit of a consumer staple stock because they obviously sell food. And so, no matter what happens to the market, we need to buy food of some sort. So I think that this is looking like a bullish chart. 50 days above the 200-day. And if we get a breakout there at 37 and a half, that would complete. Maybe this is a cup with handle of some sort. You got a little parabola here that you can draw those kind of patterns. Click 3 times and you get your parabola. And then I'll change that to green. And then I'll draw the other part. So there's the cup, there's the handle, and if we get a breakout. And that was, of course, a bullish continuation pattern. That is a bullish continuation pattern. It was popularized by William O'Neill of Investors Business Daily. So the next one I've got here is a REIT. And I don't usually do REITs, but I admit I am pretty impressed with the strength that REITs have been showing in 2018, one of the better performing groups overall. And if I look at this chart here, Duke Realty, you can see they seem to be consolidating in an uptrend. And again, maybe you have a little cup with handle working here on the miniature variety. There would be the cup part and the handle taking shape right here. So breakout at 29. And you can see the stock is up a little bit today and holding up in a bad tape. So that's kind of one of the things I usually look for when we've got a bad tape. What is holding up? Because if you can find what is holding up, that's bucking the selling pressure, and that tells you there's something going on there. Might just be one day, but in the case of Duke Realty, I think there's more than just one day, because look at this move from March to May. And then I've got HCP for my last one here. And this one looks like a bit of a rounding bottom. And again, this is another bottom pick. I usually don't do these bottom picks because they can be dangerous. But there you can see a bit of a rounding bottom, if you will. And you can see some resistance right there from those intermittent highs. Maybe you got a miniature double bottom here, and you broke above resistance, and we're continuing higher. We got a higher high here in May and June, and maybe pretty soon into early July. But this one is showing some pretty good strength here. So with that, I think I'm going to switch back over to Tom. Tom, do you have 5 for us?
I've got a few here. Let me just go through them quickly. First one is going to be in the auto parts space, Magna International. I like this one. because I like the reward to risk on it. I think we're getting down into a key area of support. We had gapped up back in May on some really strong earnings. You can see the volume had picked up. We gapped up, leaving a little bit of a gap down at about 60.5 or so. We gapped up to maybe 61.75 and then kept moving higher. Put in a double top, negative divergence. PPO was struggling there. I think we've gone back, though, and gotten to a key area of support with the PPO returning back near the zero line, just beneath it. So this is an area I think is key. And you've also got a little bit of trend line support that we could maybe throw in around 60. So let's just use the 60.5 to 61.75 area as support. I'll go ahead and just use the price right now at 61.59 as my entry for this trade. But I actually wouldn't mind a couple of entries, especially with the market being weak. Sometimes one way to minimize risk is just to slowly get into a position as opposed to just throwing everything in when the market is just kind of moving straight lower without much support out there. So this is an area of support that I would watch. I think if you get a close below, I'm going to say 60. I'd keep a fairly tight stop, but I'd be looking for a return back up to that 67 area. So I think MGA looks very strong. And at least from a reward to risk, it obviously hasn't been strong the past week or so. I don't mean it from that perspective. I mean it from a reward to risk perspective. So I like MGA. ALTR, this is a second one that I find interesting. Altair Engineering, stock's been down pretty much the last 7 or 8 days. It did try to make a breakout back, let's say about 2 weeks ago. Got up close to $38. It's now back down just below 34. You can see where we've had some tails coming down here in the 33s. The prior high got up to about 33 before we had just pulled back here. So I think this 33, 34 area is a good support zone. Might consider keeping a closing stop below the 50-day moving average with a target back up near 37. BR, which is Broadridge Financial Solutions, another one that had been moving higher. It did have a negative divergence, though. So we pull back to test this support and get close to the 50-day moving average. I think that one is a interesting reward to risk play. Celanese, CE. I'd like to see this one recover before the end of the day. I don't like what's going on right now with the failure at the 20-day, breaking to a new low. But if we can strengthen, maybe close back up over 112 and leave a little bit more of a tail to the downside, I think maybe this gap support level could offer up a nice entry. And then my last one will be CSOD. And this is Cornerstone on Demand. I believe this is in the software space. Negative divergence, higher prices, lower PPO. What do I look for? 50-day test. 3 days later, here we have it. We're back down at the 50-day. I'd like to see it hold here, so I'm going to want to keep a fairly tight stop. Maybe this prior high and gap support, which come in at about 45.5 to 46. That might, and you can see this one move down here, tested that 46 area. That might be kind of a line in the sand for me. So again, this I might consider a partial position at the current price. If it does keep dropping, say to 46, get into a second position, then maybe use gap support as my closing stop and my target being back up above 53. I think all of those could set up some reasonable reward to risk trades. So let's go ahead and summarize those trades. I know that, Arthur, you like HRL, not the food, just the stock.
Definitely just the stock.
I picked that up, and I completely agree with you, by the way. I don't want the food. And I went with MGA, and you can see we each gave a few other stocks there for your consideration. Take a look at as well. But I think Arthur would agree the market's a little shaky here. I'm not sure exactly. It'd be great to see a reversal this afternoon. But barring that, we might be in for a little bit more short-term weakness, at least based on the way we're trading and the volatility picking up would be my guess. Okay, we do have a segment coming up on Earnings Spotlight. I tell you what, this is what I did, and Arthur, feel free to chime in. I took on my Earnings Spotlight, or excuse me, in my strong earnings chart list, and what that is, I keep track of stocks that beat top line, beat bottom line, and I like their charts. And I put them into a chart list. And I went back and I took all of those that have reported during the month of June that are in that list, and I put them on an RRG chart. So I'm going to pull up this RRG. And here are all the stocks. Now, I did highlight OKTA. only because I like the way, and I've talked with Julius about this, and one of the things that he likes are stocks that have been leading, go back down into weakening, but instead of moving into lagging, they start to turn back up and head toward leading. And OKTA is one of those stocks that I think looks like it's wanting to reverse back up into that leading area. So OKTA, if you look at it, here was earnings. It broke out, big volume. It looked like it was going to make a breakout and then reversed. And it's come back down, but we've got some pretty good support here around 47.5, testing the 50-day moving average for the first time since early February. I know volume has been heavy, but in my opinion, we haven't lost any major support levels. I kind of like it, but I'd prefer it if we put like a hammer in, like a reversing candle of some sort. I don't know if you like that, or maybe I can just update this, and maybe some other stocks on this group might be appealing to you that you might see, Arthur. Anything catch your eye? Or first of all, do you use RRG?
I tend to just look at the price chart because I know pretty much what the S&P 500 is doing. I know the important highs and I know the important lows. And when I look at the price chart, I have an idea of whether they are above a low relative to the S&P 500 or not. Because the relative strength is my tiebreaker, basically. If I've got two stocks and I can't decide which one, then I'll use RRG or the scooter or something to break the tie there.
Mm-hmm.
But when you look at that chart there, you can see Adobe is up there. Well, Adobe's on the chart.
Mm-hmm. I can highlight it.
And that's one, that I would be looking at possibly. And it kind of makes that argument that you're making. You go into the weakening on a pullback or something, and then you move back into the leading. And I have used RRG in the past, and the right half of the RRG is my favorite half, because on the right half, you're outperforming. It's just the degree in which you're outperforming. All right. You're just having a little lull in that weakening quadrant until you move into the red on the left-hand side.
Mm-hmm.
So Adobe's kind of in that spot where it could easily move back into the leading.
Yeah, and one thing I think that's interesting too here that I want to point out is that notice all of these stocks, or almost every one of them, are on the right-hand side of this line. That's a good point that Arthur was making. And the reason that I like trading these strong earnings charts is that many of them, by their nature, they have just reported strong results, better than expected top line, better than expected bottom line. And I look at their charts before I put them in my strong earnings chart list. So they typically are going to have decent setups, and technically they're going to look pretty good. And so I would expect most of the stocks in my strong earnings chart list to be on the right side of this chart and outperforming the S&P. And as they start to pull back into weakening, this doesn't necessarily mean that these stocks are selling off. It just means that on a relative basis to the S&P, they may be weakening a little bit after they were wildly outperforming. For instance, ASNA was way to the right side of this vertical line here, which is telling you that ASNA was a major outperformer. And now it's just starting to work its way back. So if you look at it visually on a chart, the RRG is already telling me I've got a great stock. And this is what the RRG is saying. This stock has been on fire. I knew that without even looking at this chart based on the RRG, because it was so far right of that vertical line when you compare it to the S&P 500. Look at what happened when it pulled back and approached that 20-day moving average. It actually has been moving up, and today it's up 11 cents, even with the overall market weakening. So I do think visually, I don't use the RRGs very much either. And I tend to agree with you, Arthur. I know what the S&P is doing. I know what each individual stock's doing. And I have a pretty good sense of whether it's an outperformer or not without looking at an RRG. But if you want to compare a large number of stocks, I think the RRG is pretty interesting, because you can see at one time all of the different stocks and how they are relating to the S&P. And some of these stocks that are starting to move back into the weakening, it kind of alerts me to the fact that these could be stocks worth considering for trades.
Yeah, that's true. And that's a good point to make, Tom, is that you want to get your list And then if you put them in the RRG, that's exactly why Julius built RRG, because you had portfolio managers and they had this whole list of stocks and they had to get through them to find, the best of the best. And that's what RRG does for you. It does the sorting for you. And I believe you can click on those column headings to do sorting as well.
Yeah, you can check which.
So if you want to look at which sectors have the most yellow, green, or red, you might see something there, or you can just sort by the performance to see the leaders on the top.
Yeah. Yeah, very good point. I mean, if I click on the sectors, you can see it's broken down. Now, most of these stocks are cyclicals because number one, cyclicals look the best or among the best on the chart. If you look at the XLY,
a lot of retailers in there. Yeah.
And that's the point. I mean, that's why I try to follow this, because this tells me the stocks that are outperforming, the fact that they're performing well technically, that's how they get into the list. And then using the RRG is one way to at least kind of identify how they're performing relative to the S&P 500. Some of these are still outperforming, like this GOOS, and I'll just do this last one, then we'll move on. I want to take a look at that poll that we put up today. But here you can see Goose, after moving up, it's pulled back, but it's at the top of this gap support zone where it had a lot of volume and a lot of buyers coming in. This could be a bottoming area for GOOS, and that just quickly looking at this RRG told me that this is a stock relative to the S&P that's doing extremely well. So anyhow, that's the end of the earnings spotlight segment. Hopefully you found that interesting, kind of combining the earnings spotlight and the strong earnings chart list that I use with the RRG charts that Julius created and likes to discuss on here. And there,
well, it's a classic combination of fundamentals and technicals right there.
It is. And I don't want to give away my ChartCon presentation, but if you throw in historical tendencies, there will be my ChartCon presentation. I'm going to bring it all together.
ChartCon, is that coming up?
Oh, are we going to do one of those? Yeah, I thought I heard something about it. It's going to be awesome. I can't wait.
Yeah.
Okay, so we were talking about all the weakness in the market. And of course, China's been getting hammered. And so question here that we posed to the audience, which stock market would perform the best in a trade war? 3/4, a little bit more than 3/4 are saying the S&P 500 would benefit from a trade war more so than the Shanghai Composite. What do you think, Arthur?
We may have a country bias on this working, but no, I think what you have to do is you have to just look at the charts and you can see it. And I'm just going to grab the screen here so you can see a chart, because
this has been a June issue, right? I mean, it's basically been the last 3 weeks that all of this is really, I mean, it goes back further, but I think it's really kind of come to the forefront here in the past few weeks.
So if you look here, here's the S&P 500, and this is year to date for the S&P 500 in the top window. And it's sitting right there just above 2,700, 2,742, almost where it started there in January, kind of gone nowhere. You can see the Shanghai Composite was around 3,300, and it's down to 2,900, and that does not include today's decline. So that's going to be further down. But you can see there's the rising 200-day for the S&P, and we're still above it. And the Shanghai's been below its 200-day since the latter part of March. So Shanghai's been underperforming for a little while. And then we have a price relative here that's been rising since February there. And that's the S&P 500 divided by the Shanghai Composite. And so when the S&P 500 outperforms, this ratio rises. And it's been accelerating higher there, you can see, since the latter part of May. And so that goes to show you that as far as the stock markets are concerned, the S&P 500 is saying, hey, I can weather this better than the Shanghai Composite. At least that's the way the indices are trading right now.
Yeah, and I would even go on a limb a little bit further and say, many of the S&P 500 components, especially those that are, have a lot more exposure over in China, those stocks are getting hit harder. And when you look at some of the areas of the market where we just consider mostly domestic stocks or maybe just North American stocks, like railroads, like small caps, those types of stocks have been weathering this much, much better than even the S&P 500.
So I'm just going to plug in RUT instead of the S&P 500, and you can definitely see it. Look at the rise there, and look how far above the 200-day we are on the Russell 2000, much further than the S&P 500.
Yep. Small caps continue to outperform. And I don't know what you think about the dollar, whether you have any comments about the dollar, Arthur, but I'm a fan of the dollar. I think the dollar is going to continue to go higher. And if we get the dollar index to break above 95, I think that could continue to really push more and more money into the small cap group because they're not negatively impacted by that rising dollar like the S&P 500 stocks are.
You use the old dollar USD instead of the UUP. Whoops, I did USP.
Yep. But if you look at like rates here in the U.S. versus rates over in Germany, we continue to see that continuing to diverge. Rates here are moving up faster. So I don't see a scenario where the dollar declines. I think the dollar continues to move higher, and that should benefit small caps.
Yeah, it should definitely. And a strong dollar is definitely detrimental to large caps.
Yeah, I noticed this morning Carnival, when they reported, they actually said one of the reasons for their lowered guidance going forward, because they beat bottom line, top and bottom line they beat, but they lowered their guidance for the third quarter and for the balance of the year. And one of the reasons was the rising dollar they cited as a problem. I think more and more S&P 500 companies you're going to hear about that as we head into the third quarter.
Yeah, I saw Norwegian Cruise Lines also got clobbered.
Yep.
There's your yield chart, Tom, and there you can see the German 10-year has been declining since February.
Mm-hmm.
And the UK 10-year and the US 10-year's flat, basically, since then.
Very interesting. All right, well, we got the 10 and 10 coming up, and I know you got maybe some symbols over there, Arthur.
I do. Whenever you're ready.
I am ready. You just fire away.
Okay. You can start off with Micron, MU.
Yeah, Micron is in that semi space, which is struggling. This is a group that really bothers me a little bit in the short term. I've seen some negative divergences, but let's go ahead and pull up Micron first and take a look. I know another one, NVIDIA, I talked about a while back, I think to start June. June and July historically are not good months for NVIDIA, by the way. And all of a sudden now NVIDIA is falling apart, breaking below some recent lows. And I think Micron's doing the same thing. Now, from a daily perspective, I think we got issues here on Micron. I think if we step back and look at a bigger picture, long-term chart, I think we're fine. We put a double top in around the 64, 65 area. We're testing the rising 20-week moving average where we've had great support in the past. I think Micron is okay so long as we don't violate a couple of key areas of support. The first being the 50 area, which we broke above, came back down, hit the 20, and then went back up above. I think 50 could provide a little bit of support, but that last low at 45, if things really get bad in the semis, I think Micron could slip as far as $45. But I think the overall long-term uptrend here remains intact. And I think as we pull back further and further, the opportunity gets better and better for Micron.
Yeah, that's a great point, Thomas. If things are looking chaotic, take a step back and look at a weekly chart and get some perspective. Don't lose perspective there.
Yes. So that's a Micron. What else we got?
Okay, Walmart, which would be the other end of the spectrum, if you will, from technology and semis.
Yeah, I've been talking about Walmart for a while. It's been very weak. I expected around the $80 level to hold. I think we're continuing to consolidate. A break above 88 would start to get me a little bit more bullish on Walmart. So I'm going to highlight multiple tests here at about 88. You can see that false breakout on the daily chart. And then down the bottom here, you can see 82 holding. I think if we went to a weekly chart, and I'll look at that in just a second, but you can see 82 is your support here on a daily chart. Let me pull up the weekly chart on Walmart. And I think it was $80 that either we had broken out from. Yeah, right here, we had tops coming up at 80, broke out, big volume. We never went back down to 80. So I was thinking from a longer term perspective, if we tested 80, you can see the PPO starting to turn up. I think if we got one more move down to 80, I would actually be a buyer of Walmart. I think that this is a great long-term company. Short-term, it's probably having a little trouble with Amazon and some other competitors, but long-term, this is a great company. eventually a break back up above that 20-week moving average is what you want to see.
Yeah, and you can see that kind of broken resistance zone around in August, September, turning into support in that 80 area as well. So yeah, nice area there.
No doubt.
Okay, the next one would be AEP, the utility.
All right, well, utility's doing well. Utility's been in a downtrend, but recently are strengthening, and you can see the exact same thing here with AEP. I think we got a couple overhead resistance levels that we need to deal with. I would be okay with the stock as long as we don't get some kind of major reversing candle at one of these resistance levels. So in other words, this breakout here, if we hold it today, I think it's bullish, probably going to send the stock back up over 70. But if we put in a long tail above this area and come back down and close beneath it, that's where, from a short-term trading perspective, I would take profits. I think that the long-term chart here is still weak. I think we move down. We're sideways consolidating. Until we can take out 70 and a quarter or so, I would have a little bit of a bearish bias. But in the short term, if I'm riding this trend, I would use the overhead resistance near 70 as my exit point.
Okay.
All right. Another.
And the next one is going to be Shopify, SHOP. There's a cutting edge business.
Yeah, I'll tell you what, a little bit of weakness here. This is another one I'd like to see a reversing candle on. I don't like breaking the 20-day, although if we were to close back, if market strengthens this afternoon and we get back up to 160 and we leave this long tail and effectively test that 20-day, here was a reversing candle right on the 20-day. You got a bullish engulfing candle. So that's kind of what I'd be looking for. If we don't get that, then I think the two key areas of support are going to be at the breakout that we saw from the March high. You can see the breakout here. We're testing that now. And then the next breakout beneath that would have been kind of this double top here around 149. So I think 149 to 154 is key areas of support based on the recent highs. The rising 50-day moving average would be another area. We haven't been below that in a couple of months. I'm okay with it, but I think I'd either have to see a reversing candle or maybe move toward this second area of support before I'd be interested.
Okay, yeah, I think that one had quite a big run, so it's due for a rest as well. All right, now we're going to test your knowledge of Canadian symbols.
Okay.
Should I give you the name or the symbol?
You better give me the symbol on this one.
EMA, that's not exponential moving average, EMA.TO.
All right, I know most of the symbols in the U.S., but yeah, the Toronto, I think you get me on that one.
Okay.
Let's see. Yeah, I'm not familiar with the stock. I do like the volume coming in and the break out of this sideways consolidation. So it is starting to show better technicals for sure. You can see the rising 20-day moving average. Also, here are a couple of the resistance levels. Off of moves like this with big volume, I look for recoveries and see, this is what I call reaction high off of this move to the downside. So this establishes a key area of resistance as we go forward. We also have had a couple of highs in here at about 41 and a quarter. This was about 41.60. And you can see as volume has been expanding, we've cleared this. So I think this is a good sign. I don't like to chase. So this is the kind of stock that I would keep on a watch list. And if I got to pull back into the support zone, or maybe even all the way down to the rising 20-day moving average, this area down in here, let's call it 41 and a quarter to 41 and a half, would be an area that I'd be interested in on pullback.
Yeah, that's one of my favorite techniques there, is to look for a high volume breakout above a well-defined resistance level. And then you have a throwback to that broken resistance, which is supposed to turn into support. And that's where you get your second chance.
Yep. I've always said since I've been here at StockCharts that my style is probably as close to yours as anyone. And I think that's not good news for you, Arthur.
Or is it not good news for you? Which one is it?
Maybe both. I don't know.
We'll have a beer and we'll have a beer over it and hash it out.
There we go. One of us has to change something.
So, okay, the next one comes from the housing group, Meritor, MTOR.
Okay, well, housing in general has not been very good. This one's holding up pretty well, which means to me on a relative basis to the group, it's probably doing pretty well, because here, well, this is in the HR. That's doesn't. I was expecting HB. I'm just looking to see here. HR, commercial vehicles and trucks.
Oh, I thought it was a housing stock.
I did too. When you put, as soon as you said it, I was like, okay, I think it's like Meritage or something. I think I might be thinking of. Anyway,
Okay.
we'll still pull it up on a relative basis here. We're sideways consolidating. The group overall, you can see, is going down. So this sideways consolidation actually is pretty good. And on Friday, we actually were up trying to make a recent breakout. So I think on a relative basis, you can see that the strength is starting to come into the stock, but the overall group just made a breakdown of absolute support at about the 1900 level. So I think at best case, you've got mixed signals here on Meritor. I'm not interested really in trading mixed signals, so I don't think I would do anything with the stock. If I had it on a watch list, I'd probably just be watching to see if we could clear about 22.5. Until we did that with increasing volume, I'd probably just ignore it. But let me annotate something here. I should have annotated. But that level that I was talking about, right about in here, maybe I could even lower it a little bit. Let's call it about 2230, 2240. And there was also a previous low over here. At this bottom, we went below and we haven't been able to get back through. So I think you can kind of see this is a pretty clear area of resistance that Meritor needs to clear. I wouldn't be interested until we get through that.
Okay. Well, I went and Googled Meritor and went to the company website, and I found out that they might have some possibilities because they make something called a CIMC reefer trailer. So maybe they're getting on the cannabis bandwagon here with a special trailer. That's just a joke. I'm not sure. But they are into the commercial vehicle area. So it makes good. It's good to just double check if you're not sure about the industry.
Well, if it was getting into cannabis, I would expect it to be much higher.
That's
All right. What do you got?
Texas Instruments, TXN.
All right, semiconductors. I'm telling you, that just the whole group right now is struggling. Texas Instruments went up, put in a bearish engulfing candle off of an uptrend at resistance, and that is usually not great for the near term. I'm a fan of Texas Instruments. I think it's a great company, but we did get the reversing candle. We're now back down to the 50-day moving average, and I would start to be looking for some turnaround here pretty soon because after we made this push. And we did a little bit of sideways consolidating between about 109 and 112 for about 3 weeks before we made the next breakout. Now we're all the way back down to 109, hitting that 50-day moving average. If we don't hold here, I don't really see much support until maybe we get back down to about 105. That would be the next area because this move was pretty much straight up. So I think this is a key area. I'd want to see Texas Instruments bounce off of this, or I'd be looking maybe for 105.
Okay, and we'll go from semiconductors back over to utilities with AWK, American Water Works, I believe.
All right, AWK. I think we just got a few more. Try and get through these quickly. Okay. American Water Works, another nice move up. It's in a good space right now. It's risk off area. So all of that makes sense here in the near term. I don't personally think this is going to continue. So it's not something I would be overly interested in here in the near term, especially with overhead resistance coming up. I think this looks very similar to the AAP chart that I looked at earlier. It also looks similar to the XLU. I think we've got some overhead resistance at 86.5 that we need to pay attention to here.
Okay, and the next one is going to be from the energy sector. It is Diamond Offshore Drilling, DO.
All right, DO, after the move to the upside, I see sideways kind of flag consolidation. So I would be, if I was annotating this, I would just be looking at this nice little uptrend here, followed by sideways consolidation. Look at this false breakout. I can never talk about this too much. When you get a breakout intraday, big volume, and you fail, you almost can, well, I'm not going to say always, and there's no always in technical analysis, but the likelihood is that we're going to see lower prices after you get a false breakout. There's a reason why this thing did not hold on this breakout. This was a big level. Went back down, but then it held support around 1740. I just think we're in the middle of this trading range. So I'm not interested until either we get a breakout or we move back down toward the bottom end of this range.
All right, and we'll move back over to Veva Systems, V Victor EEV. You know it already.
Yeah, I've had this one on my strong earnings chart list before, so I'm familiar with it. It's getting hit hard, down almost 5% today, losing some areas of support, or at least maybe testing first area of support. And there you have it. So there you can see the tops coming across. There was a false breakout. We go back to the 20-day moving average. Then we get the breakout, and the volume's pretty good on that breakout. We come back down. This is the throwback that Arthur was talking about. You go back down, you test that breakout level, and then you move back higher. That's why I don't like to chase when we get these moves. Many times you're going to get that move back to the downside, so you might as well wait for it. We're back down there again with the rising 50-day moving average coming up just from underneath. I think that the two key levels are the ones is the support level I've drawn in there, plus the recent low right in here. This is an area I'd really like to see Viva hold during a period of weakness. And if we can get a reversing candle, I'd be interested. Otherwise, I would just let this thing play out until it looks more tradable. I don't like today's decent volume, big red candle. I either want to get a reversal or let this thing move back down closer to a key support level with a reversing candle. And I believe that was the 10th one. So
that was the 10th one.
Yep. So let's go ahead and just summarize this for everybody. And you can see the 10 stocks, 10 symbols that we just went over. And really the whole purpose behind this is just to show you how quickly you can annotate these charts, save them, put them in a watch list so that you don't forget. Because I don't know about you, Arthur, but one of my biggest problems in the market sometimes is I see something, I think it's tradable, and if I don't put it in a chart list, it goes right out, the other ear, and I don't see it again until it's 10% higher, and I'm like, well, why didn't I get that one? Why didn't I own it?
So, and that's a good point, because you want it in your chart list so you're seeing it every day. Exactly. And you'll see it when it comes into that buy point that you like. Instead of chasing something, if you have enough in your chart list, you're going to be able to let that stock come to you and get it on your terms.
For sure. Okay, well, there's your 10 and 10. There's the summary, and we're going to just take a minute. We'll be back in just a minute for your final market update.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
Okay, welcome back, everybody. Let's take a quick look at what's going on in the market. You can see the Dow here just trying to make a little bit of a turn. We are still down 361 points. You can quickly use this market overview part to just get a quick update on what's going on with the various major indices. Here's the NASDAQ, again, trying to turn up, but really not much off the bottom so far. The S&P 500. Also, if you click down here below, I can click on the Russell 2000. It'll give me a little bit of a small picture of what's going on in the Russell 2000 over the last 24 hours or so. These panels you can use, but I'm going to focus just to give you a really quick look at what's going on. Let's go down to the sector summary over here in the Pro Control Center on your members dash page or dashboard. If you pull up that sector summary, you'll see very quickly which groups are leading. And one of the things I like here, I always start my day with this sector summary so that literally 5 or 10 minutes in, I can just see where the money is moving into, where it's moving out of. And that doesn't mean it's going to continue all day, but at least gives me a sense of what traders are looking at early in the day. The other thing I love about this page is that in addition to an intraday period, if you wanted to say, well, the market's, let's just say the market's been weak over the last 1 week period or 1 month. Let's take a look at 1 month. What is leading the market over the last month? Consumer stocks, consumer staples, and cyclicals. And if I pulled up cyclicals, you can see that many of the retailers are near the top. Arthur talked about this earlier when we were talking about those RRGs and many of those retail stocks being way out to the right-hand side on the RRG, well above the benchmark S&P 500. Another way of seeing that is by simply going back and looking here at the sector summary, in this case, drilling down to the industry groups, and within the consumer discretionary, looking at 1 month, and you can see which groups are leading and which ones are lagging. Gambling stocks continue to be weak. Home construction, really poor. I pulled up that chart earlier so you can see just a different way of looking at the market. Okay, Arthur, I know we've got one more segment here, and you had spent some time putting together some work on risk on, risk off analysis, and I think everybody's going to enjoy this. So I'm going to let you take it away and go in toward the end of the show with it.
Indeed, I will take it away here because, we don't always get it, this risk on, risk off macro environment. We had it, of course, in 2011 when you had the European sovereign debt crisis. That's kind of when the term really hit its peak. Everybody's talking about risk on, risk off assets. And I just want to show a couple of risk off assets and that you can watch. And if they continue to strengthen, that would be a negative sign, I think, for the global markets. And by extension, it could also affect some other sectors like utilities and banks. And the first one is TLT. And there are a lot of bonds that you could use. I mean, it really doesn't matter. You could use IEF, the 7 to 10 year Treasury bond ETF, AGG, the aggregate bond ETF, the zero coupon bond ETF. It really doesn't matter because they're all so highly positively correlated. You can pick one. But I think TLT captures it the best for me. And we can see that here's this big move we had in May, at the end of May. And that was, of course, when we had the Italian election and the market got all scared that Italy was going to suddenly leave the European Union. And then that went away and bonds pulled back here. And then we had another upturn here. And this might be from trade wars or something else. But basically, bonds are the ultimate safe haven. All right. You buy them as a alternative to a riskier asset such as stocks, or you buy them if the economy you think is going to deteriorate. And that means the Fed is going to have to lower interest rates, and that means bonds are going to go up. Now, bonds are still in a long-term downtrend, all right, which means the 10-year Treasury yield, which is just below it, is still in a long-term uptrend. That was a 52-week high for the 10-year there, around 3.1%, which is 31 on the chart there. The reason I use $TNX is because it is updated during the day, as opposed to $UST10Y. That's just end-of-day chart. But looking at TLT, you had the pullback, and then there's that breakout. So we've got a short-term breakout, and that talks to a little bit of risk aversion in the markets. And the big zone to watch is here around 122, 123. And if we break out there, then that's going to reverse the long-term downtrend in Treasury bonds. Maybe it's a massive double bottom here, but a breakout, I think, would be negative for the stock market. It hasn't happened yet, but it's something to watch. And then by extension, if the 10-year yield were to break this support zone, that would be quite a negative development. Now, the other one that I watch here would be the Japanese yen. Now, it's not as strong of a risk-off currency as it once was, but I think it is still the risk-off currency out there. It's a complicated issue. I think you need to Google it and read about it to really learn about it. I can't sum it up in a couple of minutes here. But for some reason, the yen is the go-to currency when the global markets are in a little bit of turmoil or uncertainty. And if you look at this yen chart here, this is the yen ETF. It surged from 84 to 91-ish and then pulled back kind of to this broken resistance, turning into support here and right around that 61.8% retracement. So it retraced around 2/3, say, and then it popped, and there was the pop with the Italian election, and then it faded back, but it's tested this support level and it's turning up again. So if the yen breaks out, that would be a sign of risk aversion in the markets, and that would be a potential negative. And I've got the euro down below. The euro accounts for like 57% of the dollar ETF. And I think the yen is somewhere around 13, 14%. But the euro is the main driver for the dollar. And the euro is in a breakdown mode. Maybe it bounces back, oversold bounce, but I think it is in a downtrend. So what happens if we see, well, if the yen moves higher, that's going to be negative for Japanese stocks because they are export-driven economy, so a stronger yen would not help. And another thing I look at is a ratio. All right, this is a ratio of SPY to IEF, the 7 to 10 year Treasury bond ETF. And when this ratio rises, stocks are outperforming, as we did from September up until January. And that's bullish because stocks should outperform Treasury bonds in a risk-on environment in a bull market. And then, of course, we had the volatility in February and the test in March is the S&P below. But we've been outperforming bonds again since the latter part of March here, with higher highs and higher lows in this ratio. So there's that low from May. And I'm not going to call it support because it's a ratio chart. All right. It's not like there's a buyer there at 2.60 because it's a ratio of SPY and IEF. But if we do break below that low, that would suggest that a downtrend has started because it's a lower low. All right. And that would mean that bonds are starting to outperform stocks, or stocks here would be underperforming bonds. And that would be a negative for the market. So that's something to watch going forward. I also mentioned seasonality, since we've been talking a lot about seasonality. I know it's one of Tom's things. I was looking at a seasonality chart for the US bond, and this is symbol dollar USB, and it goes back over 20 years. So I went to the max 20. If you want to see what it did what it did before that, you can slide the whole slider over and then see. But look at July and August from 1990 to 2009. And then if we do the last 20 years, there's some overlap there. But 1999 to 2018, you can see June, which we're ending now, coming to the end, is a weak month for bonds, but July is a strong month for bonds, 68% of the time closing higher. Average gain is 0.5%. And August is the strongest month of all for bonds, up 74% of the time, and average gain is 2.1%. So this tells me that there could be some bullish tailwinds coming for Treasury bonds, and it's something that we should watch going forward. Now, how can we apply this to the stock market? Well, we know that there are certain interest rate sensitive issues out there. And the first one would be, of course, utilities. And I do not need that little / or backslash. But you can see utilities, if Treasury bonds move up, they're kind of like a bond proxy, and they have a positive correlation to bonds, and they're going to move up. So to prove that, I'm just going to put on the correlation coefficient here. There's the indicator. And I want to correlate it to TLT to see how bonds and utilities are correlated. And there you can see a very strong positive correlation. And that means when one moves up, the other one tends to move up. When one moves down, the other one tends to move down. So if bonds are going to turn up and break out, then I would expect utilities to remain strong. And you can see they're having a pretty good month of June here with this huge move up and about to break above that April high there. Now, on the flip side, I think everybody knows which symbol I'm going to replace that U with. It will be XLF, and that would be the finance SPDR. And this has been one of the weakest ETFs, one of the weakest sectors in 2018. There you can see the correlation coefficient. It's mostly negative. So that means when bonds rise, financials tend to decline. Now, correlations, relative strength, sentiment, seasonality, they're all good indicators to use, but I think you have to use them in conjunction with the price. All right, use them to back up what you're seeing on price. Price is the ultimate arbiter here when it comes to making your trading decisions and making your bias or your bets. And if you look at this chart here for XLF, it is consolidating here, and it's on the verge of breaking support. In fact, you could even make the case for just a massive descending triangle. Now, descending triangle is usually a bearish continuation pattern, and this one's forming after a 52-week high. But basically, you come down to support, you get some buying pressure and you bounce. You come back down, demand comes in, buying pressure and you bounce, and again, and again, and again. But the thing is, selling pressure comes in below this high. So you have selling pressure coming in quicker. You have selling pressure coming in even quicker here in May, and then selling pressure coming in even quicker in June. So the sellers are just more and more eager to sell at lower highs. And this is the last bastion of support for demand. And if you break that, then that would probably argue for a test down to these lows here in the finance SPDR here. And, you know, if finance breaks down, that's going to be quite a negative for the stock market. It hasn't happened quite yet, but when you look at some of these stocks, these big financials, they don't look good. Bank of America is not looking very good. All right, it's breaking below its 200-day EMA there. And there's always the eternal debate, EMA versus SMA. In the grand scheme of things, it really doesn't matter. It's just a personal preference. I just like an EMA because it weights prices more towards recent data. And it's really not a support level in my book. It's more like I use these two EMAs to decide the direction of the long-term trend. All right, the long-term trend is still up, but this is not a pretty chart because you're breaking below these lows. And it's definitely showing relative weakness, so I wouldn't even have this on my watch list. Another group that kind of performs good along with bonds sometimes is consumer staples. And I noticed this one, Kimberly-Clark here. Now, it's in a downtrend. It's a big cap, large cap consumer staples stock, but it's getting a bounce today in a bad tape. All right, so maybe it'll get an oversold bounce if the market does continue to correct. And you can see there's a semi-positive correlation with Treasury bonds, not as strong, clearly not as strong as the correlation that utilities have. And then the other one that I noticed that is just, and this is kind of like the poster child for the tariff issue, and that would be Caterpillar. You know, it's breaking down. And the industrial sector has been one of the weakest sectors. And so, you know, when I talk about keeping the powder dry, and Tom is also talking about, you know, we may be in for a little more weakness before we finally find some firmness, it all kind of ties into the fact that, you know, industrials are underperforming, finance is underperforming, finance is even outright weak. And there you can see industrials breaking below that 200-day EMA. So they're very weak. So how's the market supposed to, you know, rally and be in a bull market when you have two of the offensive sectors, financials and industrials, really underperforming? So you take all that kind of together, you know, bonds trying to turn up, the yen trying to turn up, good seasonality for bonds, and then weakness in XLI and XLF. And then XLY, the consumer discretionary, and XLK, technology seem to be ripe for a correction. And so all that kind of points to a pretty choppy summer, if not a correction going into the summer. And so we're coming down to the last 5 minutes, and I'll bring Tom back in for some closing thoughts.
Yeah, you know, I was looking at some of the stocks that you're mentioning there, in addition to the trade fears. I think, too, the dollar, the fact that the dollar's been rising so rapidly, I think it kind of, both of them, it's almost like a 1-2 punch. Some of these multinational companies and many of the industrials and so forth, because they are subject to the tariffs. Many of the materials companies as well. We've seen a lot of weakness over the course of the last month or so because of so much of the trade talk dominating a lot of the action out there. But I mean, if you had to give everybody wants your gut feeling here, Arthur, because, you know, we talked about, well, the TLT could break out. We could see this, we could see that. what do you see in the second half? I mean, if you look into the Arthur Hill crystal ball, are you looking at a market here in the U.S. that goes higher with rates going higher? Do you see maybe the rates, yields breaking down and stocks going down with it, or you just see more consolidation? What are your thoughts as we move into the second half of the year?
Well, as far as the S&P 500, or if you say SPY, I would say we're going to see more consolidation and maybe, into this 267, 265 area, then maybe we'll shop around here. But yeah, you got some sectors strong, some sectors weak, and it's the perfect storm, or not storm, it's the perfect recipe for going nowhere. And I think bonds could get a breakout, but I don't think it's going to hold because, like you, I do think the long-term trend for Treasury yields is up, and that's going to resume at some point, but it might not be until after the summer. So I would be perfectly happy to keep the powder dry until, the latter part of August, early September.
Yeah, I'm not nervous longer term or even intermediate term. I'm definitely nervous very short term, like today and tomorrow, because we do have the volatility index now up 35% to almost 1860, and this would be the highest close in the VIX since back mid-April. And anytime that volatility starts shooting up, we can take very quick, steep drops in the market. So if we finish on the high of the volatility index today or close to it, I think we could gap down tomorrow.
Yeah, it's a big move up in the VIX. It's basically it's its highest level since late April.
Yep.
So it did hold above that autumn low in November, December, when it pulled back here in April, May, and turned back up.
Yep. And right now, just to give everybody a quick update, we do have the Dow Jones down 372 points, and NASDAQ still down 191. The S&P down S&P 500 down 44.65, and the Russell 2000 down 28. Everything getting hit pretty hard today. But Arthur, it was great having you on the show today. Everybody can kind of see the upcoming schedule. But thanks so much for joining me today, Arthur.
Great to be here, Tom. You guys have a good day.
Thanks, you too. Also want to thank all of you for being with us today. Please remember to complete the survey as you exit. We'd love to hear what you thought of today's show and of Market Watchers Live in general. I'm sure Arthur would like to know what you thought of the risk on-off analysis he did at the end of the show. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great afternoon, everybody. We'll see you back here tomorrow. Happy trading.
You've got a problem. Your investments aren't growing as fast as you'd like. So you did a smart thing. You opened an online brokerage account and started learning more about the financial markets. But now you have a bunch of new questions, like, which stocks should I buy? When should I buy them? When should I sell them? You tried watching the talking heads on the financial channels, but they just gave you untimely advice that the real pros already knew about. It's all starting to feel a bit too little, too late. But what if there was a way to know, to truly know, what the market was thinking and how it was behaving, even before the pros? What if you could learn where the market was headed while there was still time to profit from that knowledge? With StockCharts.com, you can. Trusted by thousands of online investors, StockCharts.com has the charting tools and analysis resources you need to make smarter investing decisions. Our intuitive web-based tools make it easy to create high-quality financial charts in just a few simple clicks. Save and organize the charts you're watching to make managing your portfolio a breeze. And when it comes time to buy, our unique technical ranking system sifts through the markets and quickly points you to the most promising stocks and funds. You had a problem until you found the solution at StockCharts.com. Start your free 1-month trial today and see what superior financial charting can do for you. StockCharts.com. simply the web's best financial charts.